Ever wonder how your money can work for you instead of the other way around? Let's embark on a journey to understand the power of financial investment. It's a realm where money isn't just a medium of exchange, but a tool that can be wielded to create more wealth, to grow your resources, and to secure your future. Imagine you plant a seed today. With time, care, and patience, that seed grows into a tree, bearing fruits year after year. Financial investment works in the same way. You invest your money today, and over time it grows, it multiplies, and it starts to bear the fruits of your patience and wisdom. Now you may be wondering, how exactly does this happen? The answer lies in a magical phenomenon known as compound interest. It's the process where you earn interest not just on your original investment, but also on the interest you've previously earned. It's like a snowball rolling down a hill, growing bigger and faster as it descends. Let's say, for instance, you invest $1,000 at an interest rate of 5% per annum. In the first year, you earn $50 in interest, but in the second year, you earn interest on $1,050, not just your initial $1,000. That's an extra $2.50 earned without lifting a finger. Now imagine this process repeating year after year, and with larger sums of money. Over time, the power of compound interest can turn even modest savings into substantial wealth. This isn't a get-rich-quick scheme, though. It requires patience, planning, and a pinch of courage. But the rewards can be life-changing. It's how many of the world's wealthiest individuals have built their fortunes. So you see, financial investment isn't just for the rich and famous. It's for everyone who wants to make their money work for them. So, what are the different ways you can invest your money? Well, let's dive right in and break down the main types of investments: stocks, bonds, mutual funds, and real estate. First up are stocks. When you buy stocks, you're buying a piece of a corporation. You become a shareholder. If the company does well, so do you. Your shares may increase in value, and some companies may even pay dividends. But stocks can be risky. If the company doesn't perform well, the value of your shares could go down. Next, we have bonds. Bonds are essentially loans you give to a company or government. In exchange, they promise to pay you back with interest over a certain period of time. Bonds are generally less risky than stocks, but they also tend to have lower returns. Third on our list are mutual funds. These are a type of investment where you pool your money with other investors to buy a diverse range of stocks, bonds, or other assets. This diversification can help reduce risk, but remember, there's still no guarantee of returns. Lastly, let's talk about real estate. This is when you invest in property, whether residential or commercial. You can earn money through rental income or by selling the property at a higher price. Real estate can offer substantial returns, but it's also subject to market fluctuations and requires a significant upfront investment. Now remember, each of these investment types has its own potential returns and risks. Stocks and real estate can offer high returns but come with higher risks. Bonds are generally safer but offer lower returns. Mutual funds offer a balance of risks and returns through diversification. So it's all about finding the right mix for you. Your financial goals, your risk tolerance, and your investment timeline will all play a part in deciding what type of investment is best for you. Keep in mind, each investment type comes with its own set of risks and rewards. It's up to you to weigh these factors and make informed decisions. And remember, investing is a long-term game. Patience, my friends, is truly a virtue when it comes to the world of investing. Now that you know what financial investment is and the different types, how do you start investing? Well, the first step to start investing is to set financial goals. Are you investing for retirement, to buy a house, or to fund a child's education? Understanding what you're investing for will help you decide how much you need to invest and for how long. It's okay if you have multiple goals. In fact, it's quite common to have short-term, medium-term, and long-term investment goals. Next, you need to understand your risk tolerance. Simply put, risk tolerance is your ability to endure the ups and downs of the market. If the thought of losing money keeps you up at night, you might have a low risk tolerance. On the other hand, if you're comfortable with taking on more risk for the potential of higher returns, you might have a high risk tolerance. Remember, there's no right or wrong answer here. It's all about what makes you comfortable and aligns with your investment goals. Now let's move on to the practical steps. First, you'll need to open an investment account. This could be with a traditional broker, an online broker, or a robo-advisor. The choice depends on your preferences and needs. For instance, if you like a hands-on approach, You might prefer a traditional broker. But if you're comfortable with technology and prefer a more automated approach, a robo-advisor might be a better fit. Once your account is set up, it's time to choose your investments. This is where your understanding of different types of investments comes in handy. You might choose to invest in individual stocks, bonds, mutual funds, index funds, or a combination of these. Your choice should align with your investment goals and risk tolerance. Finally, make a commitment to regularly contribute to your investment account. You might choose to do this monthly, quarterly, or annually. Regular contributions can help you take advantage of a strategy called dollar cost averaging, where you buy more shares when prices are low and fewer shares when prices are high. Remember, investing isn't a one-time thing. It requires commitment and regular contributions. So, how do you decide where to put your money? What strategies can you use? The million-dollar questions. Let's delve into some common investment strategies that seasoned investors swear by. First up, we have diversification. Think of it as not putting all your eggs in one basket. Diversification involves spreading your investments across a variety of asset types, such as stocks, bonds, and real estate, to reduce risk. The idea is that if one investment performs poorly, the others may perform well and offset the loss. It's a way of hedging your bets, and it's a key component of a balanced portfolio. But what does a balanced portfolio look like? Well, it depends on your financial goals and risk tolerance. If you're young and can afford to take on more risk for potentially higher returns, you might lean towards more stocks. If you're nearing retirement and want less risk, you might favor bonds. The point is, a balanced portfolio is tailored to you. Next, let's talk about dollar cost averaging. This strategy involves investing a fixed amount at regular intervals, regardless of the price. The beauty of dollar cost averaging is that it removes the guesswork. You don't have to worry about timing the market. When prices are high, you buy fewer shares, and when prices are low, you buy more. Over time, this can reduce the average cost per share of your investments. And then we have long-term investing. As the name suggests, this strategy is all about the long game. It involves buying and holding investments for several years or even decades. The idea is to ride out short-term market fluctuations and benefit from potential long-term growth. It's a strategy that requires patience, but it can be very rewarding. In conclusion, these are just a few of the strategies you can use to navigate the world of investing. Remember, there's no one-size-fits-all approach. Your investment strategy should align with your financial goals and risk tolerance. Scene script. Let's revisit the key points we've discussed today. We started our journey by understanding the power of financial investment. It's not just about putting your money somewhere and hoping for the best. It's about making your money work for you, with the magic of compound interest amplifying the effect over time. This power, combined with a disciplined approach, can transform a modest saving into a substantial nest egg. Next, we explored the many types of investments available. From stocks and bonds to real estate and mutual funds, each one offers a unique set of advantages and risks. Remember, the choice of investment should align with your financial goals, risk tolerance, and time horizon. There's no one-size-fits-all solution here, so take time to understand each option before diving in. Then we ventured into the world of investing itself. We discussed how to start investing, from opening an investment account to choosing your first investment. We emphasized the importance of starting small, learning as you go, and gradually building your portfolio. It's not about getting rich quick. It's about growing wealth steadily over time. We also touched on common investment strategies. Dollar cost averaging, diversification, and rebalancing are just a few of the strategies that seasoned investors use. These strategies can help mitigate risk and optimize returns over the long run. Remember, investing is not a sprint, it's a marathon. Patience and discipline are key to success. Lastly, we stressed the importance of regular investment and maintaining a balanced portfolio. Regular investment, even in small amounts, can lead to significant growth over time thanks to compounding. A balanced portfolio helps to spread risk and increase the potential for returns. Investing may seem daunting at first, but with these steps, you're well on your way to making your money work for you. Remember, the journey of 1,000 miles begins with a single step. Start small, learn as you go, and let the power of financial investment guide you towards your financial goals.